you know the rich buy cars differently than not rich? Well, this video will teach you how to buy a car with your bank and actually help you financially. Or in other words, we're gonna talk about how to make you look sexy for the bank. Now, when we talk about the rich versus the not rich, here's the truth, is that the rich do all kinds of different things. They might pay cash for it, or they might get bank loans for it. But I wanna focus on the latter, because we all know we can pay cash, and there might be a reason for that. But for those of us that have become more financially savvy, we realize that although we could just pay cash for things, and sometimes we do, the truth is, it's actually kind of fun to leverage the bank and use them so we can make more money with the money that we have. All right, so first and foremost, let's just get right to it. How do you look sexy for the bank? And I don't mean going in dressing up, looking all suave, or putting on your best dress and doing your makeup and hair, and women too. I'm not talking about that at all, right? I'm talking about really trying to show up to look sexy financially for the bank. This is where accountants might think you're sexy, not necessarily you, right? But how do you look good for the bank so that they think you're a safe investment? Because the truth is, if you're wealthy, they know that you're great. They know you can pretty much just walk on water and do whatever the heck you want. But maybe you're not there yet. So, and here's some things I've learned, especially when I used to have a horrible credit score. Here's some things you can do right now to look good. So really there's three things that a bank looks at when they're looking at your situation. One is your credit score. Of course, that's something that we always hyper focus on. It's not everything. Despite what people think, you can have a perfect credit score and still get denied a loan from the bank. Now, what contributes to a credit score? First and foremost, of course, on-time payments. But it's not just that. Not just on-time payments, but also how long you've had certain lines of credit. So if you have a credit card, do not do what Dave Ramsey tells you to do by cutting it up and canceling those cards. That's for people that can't control their spending, and that might make sense for them. But if you're trying to build credit so that you can get lower interest rates, giving you better bang for your buck, you want the longest credit history possible. Now, maybe you're just starting out, maybe you don't have a lot of credit history. I'm gonna give you a little bonus here. Here's a little cool trick that I've actually used for myself, especially when I was in my 20s. You can go to parents, for example, and say, listen, do you have credit cards you've had for a long time? And I guarantee they do. And say, can you put me on as an authorized user? This is key. It's gotta be an authorized user. Ask them to put you on as an authorized user, and they'll say, why? What do you want for it? I don't want to use it at all. In fact, just send the card to your address. You can chop it up, you shred it, do whatever you want. I don't need the card. I just want the credit history from that card. Here's a key point. You got to make sure it has a good credit history. So if they've had late payments, don't put your name on that, right? You don't want to hurt your credit score. You want a good, better credit score. But if it's something that they've had for a long time, it actually boosts it up. I did this for myself. I was actually looking to buy a car. It was a Mercedes, the first time I ever bought anything that expensive. I mean, much more expensive than anything I'd bought in the past. Well, they said, hey, your income looks great, but your credit score is not as good. Like, there needs to be more credit history for us to feel comfortable to give you the best interest rate. Well, I remember hearing about this trick. I went to my dad and said, hey, you remember that credit card that I bought college books for back in 1995? Yeah, put me on as a user. Why do you want it? I don't want it. Take it, shred it. So he did. It got on my credit. The next month, my score jumped up 23 points just because his credit card was showing up on my credit report. So there's a cool little bonus for you guys. So again, credit score is key. That's number one. Number two, do you have some savings in the bank? This is really good for possible leverage, because if you have some money you could put as a down payment on your car potentially, or just money in the bank to say, listen, I've got X number of months, I could keep making this car payment for a long time. Banks love that. They love to see that money just sits around and does nothing. Ooh, by the way, here's another key bonus. If you have an infinite banking policy, you can use that money to also look good for the bank. I actually will send them my statements, just like when I do for mortgage applications. I'll send them my balance for my infinite banking policy because I don't use that money. I just send them that, and they check it off the list, say, looks sexy, next. So do that, have cash reserves. And then the third thing to look sexy is the one that most people don't realize is what's called a debt to income ratio. Debt to income ratio says they look at your income and they compare it to the monthly payments, the minimum monthly payments that you have on your credit report. Ideally, they're down here, because they want to see if you can afford the payment. Same thing for you. You would want to make sure you can afford the payment as well, right? Well, if you have too high of payments, let's say, for example, you try to aggressively pay off all your loans, you try to get a 10-year mortgage, which is crazy, by the way. If you try to get a 10-year mortgage, that payment's gonna be higher. They're gonna say, ooh, we don't want to give you that loan because your payments are so high because you're required to make those. By the way, here's a key point. If you want to pay off your mortgage in 10 years, don't get a 10-year mortgage. Get a 30-year mortgage, make a 10-year payment. That way it looks lower, so when the banks look at it, they say, oh, you look safe we'll give you the best interest rate, or we'll even at least give you the loan. So do that instead. So that's the thing. The three things are that: credit score, cash in the bank, and debt to income ratio. Good debt to income ratio. They like to see it below 45% if you include your house payment. All right, here's another key point that wealthy people do. We develop good bank relationships. Often, wealthy people will even know the president or the vice president of a bank or a credit union. It might be a local one. You might start small, but start to develop those relationships. Get to know people that are in the bank of power. You know, it's not just the loan officer, which is a good start, of course, but get to know somebody that's more higher up. I've had friends, for example, when they go to their local bank, a little credit union that they grew up in their small town, and then they'll go to them, they'll say, hey, I want to get a car loan. And they're like, you know what? Approved. We'll give you a 1.9% car loan for the next 5-6 years. Now, that's not what they advertise. They don't show that on their rates on the bank website. No. It's just because they have a good relationship. So I recommend the same thing. Get a good long-term relationship with your bank. Don't go for the huge banks like your Wells Fargos or Chases. It doesn't mean that they're bad, but you want a smaller bank that you can actually get better relationships to the top. There's less red tape and bureaucracy to get through. The one thing that we love to do is we do longer term loans. Just like I said about that mortgage, right? Don't get the 10-year mortgage, go for the 30. Same thing for the car loans. Instead of getting a 3-year car loan, instead look at a 5 or 6-year car loan, maybe longer. Why? Because it means your payment is less. It makes it less. You want to have a lower payment because, again, it makes your debt to income ratio look better. So when you do other loans with the banks, it looks great. And this is even true when I go and buy investment properties. They look at everything. They look at my debt to income ratio, my credit score, my cash reserves, and they say, hey, let's see what it looks like. I want to show them those lowest payments possible to make it look like I'm hardly paying anything. But my income is great. So my income's up here, payments are down here, and they think you are awesome. That's what you want as well. You want to have those longer term loans so that you pay less. And even just from a pure, simple standpoint of this, if anything happens in your life, any emergency comes up, anything happens to you, you want to make sure that you're not in trouble, right? You want to make sure that if worst comes to worst, either your income drops, your expenses go up, you have a low payment that you're required to pay so that you don't kill your credit score. That's why you want the longer term loans. All right, guys. How about one more bonus, okay? I'm gonna give you one more. Here's a strategy you can use as well. We've done videos about this before, but there's another thing you could do. Let's just say that you're really tempted to want to still use cash. Maybe you're saying, I don't know if I wanna really use the bank. Well, one thing you can actually use is your infinite bank. You can actually use a whole life insurance policy. You have cash in there, but instead of just withdrawing the money, which is an option, you can pull the money out. The thing is, when we're wealthy, we know that when you pull money out, you lose the ability to earn interest on that money. Now, you might not be paying any interest, but you lose the ability to earn interest. But if the money's in here, we say, listen, we can get a line of credit against it. You can either, one, get it from the insurance company, which may or may not be a higher interest than right now. Right now, currently, if you look, and depending on the insurance company, they can actually be lower than what the banks offer you. So instead, you get a line of credit from the insurance policy, use that money to go and buy your car and cash outright. The good news is, it's not on your credit. It doesn't show up at all. You can actually be making the payments whenever you want. So if you don't make a monthly payment, which are not required anyways, no problem. Doesn't hurt your credit because it's not on your credit. You can pay back those loans whenever you want. That's the beauty of it. So not only can you get a lower interest rate, but you can also be able to get that money working for you and save on interest too. Oh, here's an extra bonus. You may actually look at using the insurance company, but you might also check with your local bank and say, listen, can you do a collateral assignment of the cash in my policy? Which means if you use my cash as collateral, knowing that it's there, it's guaranteed to keep growing. That's why they love whole life insurance. It's a secure place to store money, better than a savings account. You say, hey, if I use this as collateral, will you give me a better secured line of credit against that car? And a lot of times they'll drop the rate. I had one client who actually did this on a building. He was buying a building for his business. He was a chiropractor. He said, I think I'm just gonna cancel my insurance policy and just use cash to pay this off. I said, don't use cash to pay it off. Let's think like the wealthy here. Instead, go to your bank and ask them if they'll give you a collateralized secured line of credit using the life insurance as collateral. Guess what? They did. They even loaned him more money than what was inside the policy. They dropped the interest rate by more than 2% of what they're offering anybody at that time, which means his payment was lower. He was paying $1,800 a month. He got a few renters in there for the extra office space that now paid his mortgage payment for him. And then after a year and a half, what did he do? Went back to the bank and said, hey, can we take this lien off my life insurance? They said, yeah, of course. Took it off. His $300,000 his life insurance was now able to be invested however he wants, and he still kept the same terms on that loan. He still had that super duper low interest rate. An interest rate so low that it wouldn't even be worth paying off. He could make way more money investing than that interest rate. In fact, it's what allowed him to make more money. That is how the wealthy think. That's how we use banks to our advantage. We want to get those lowest terms, the best terms possible, so that it works in our favor so our money can work harder for us. Guys, if you think that's awesome, check out this next video, how to make $5,000 a month in passive income right now.